Monday, August 3rd, 2020, Maneco 64, home of alternative economics and contrarian views. I'm going to talk about the bond bubble today. I think the bond bubble is the biggest bubble ever. It's even bigger than the stock market. How long can it keep going? Probably for a while. And why is that? Well, because the central bankers are the ones behind the bond bubble. They're the ones who have continued to save the bond market. And by that I mean they've issued reserves or QE to purchase treasuries, government bonds in Europe, government bonds in the UK, Japan, and everywhere else, mortgage-backed securities. And when central bankers telegraph to the market that they're going to keep doing that, and that is called forward guidance, so of course, telling them that they're going to keep rates low for as long as the eye can see. That means that they're going to keep a put under that market, that they're going to keep buying it. And it forces investors, pension funds, all kinds of institutions who are forced by law to hold bonds to go for even riskier assets, riskier bonds. And of course, the higher the yield, the riskier the bonds are. And so nowadays, with so many bonds at zero or even negative, I think it's very dangerous what these fund managers or fiduciary agents are doing with other people's money by having them in bonds. I don't think this can last. It's not natural. It's not within the laws of economics, because bonds basically are loans, they're cash flow. And once the currency collapses, the bonds will collapse once the fiat currencies collapse. So I think it's the biggest bubble of them all. The bond market is even bigger than the stock market. So today I'm going to quickly look at an article I've seen here on Zero Hedge about the world bond market, or global debt as they call it. Then I'll look at the markets to see what they're doing this morning here out of London. So more than 60% of global debt now yields less than 1%. So that's from Zero Hedge. The basics of bonds are that the higher the prices go, the lower the yields go. Also, someone might ask, a lot of you have asked, how can people buy bonds that have a negative yield? That means they're making no returns. Well, a lot of those are bought by speculators, because once bonds go negative, the price rise of those bonds is even bigger, especially for bonds that mature in a long period of time, like 10-year bonds, 20-year bonds, 30-year bonds. We've even got 100-year bonds now. So if you go from zero yield to minus 0.5% yield in a long-term bond, the price goes up quite a lot. So yeah, they might not make an income from that bond, but they make big capital gains. So it's become highly speculative, these bonds. So it says, for all its monetary generosity, despite injecting $3 trillion reserves into the banking system, if not the economy, the Fed remains stuck with two big problems. The first one, as we touched on earlier, is that the newly printed money is unable to make its way into the broader monetary plumbing and spark the much needed inflation that will do away with the trillions in debt. They want to monetize the debt, of course. They want to write off the debt with inflation. And by inflation, they mean rising prices. Although, as we also noted, the Fed now has a plan to deposit digital funds directly into individual US accounts using a household app, in the words of former Fed economist Julia Coronado. That's another story that's about helicopter money. The other problem is that despite all its attempts to stimulate equity animal spirits, the bulk of new funds has flowed into bonds, not stocks. In fact, year-to-date, equity outflows amount to $39 billion, while inflows into bonds and commodities are over $200 billion, with a whopping $1.145 trillion going to cash via money market funds. And so, with so many investors stubbornly buying one asset class, the Fed does not want to be in wide demand, even as it monetized some $3 trillion of it, and even with trillions more in new debt to be para-dropped by the US Treasury, something which has failed to taper demand for 10-year treasuries, whose yields just hit an all-time low. The hunt for yield is getting harder than ever for fixed income investors. Well, they're not really getting an income, most of them, or most bonds are not giving a real income, because if you compensate for the rising cost of living, if you want to use the CPI, even the CPI, the real rate is negative. So let's keep going. According to the FT, a record 86% of the 60 trillion global bond market tracked by ICE data services traded with yields no higher than 2%, while more than 60% of the market yielding less than 1% as of June 30th. So yeah, there's no return there. It's becoming like the 70s. The 70s, of course, nominal yields are quite high, but the inflation rate, or the CPI, was a lot higher. So there were negative real returns. And now we're getting the same in the year 2020. So here's a chart that they've done. Giant pool of low yielding debt pushes investors into riskier assets. And why is that? Well, pension funds, hedge funds, investment funds, family offices, people who have liabilities, who have to pay the policyholders some kind of income, they will have to buy bonds that are riskier, that yield more, that give a larger or higher coupon. So here we go. This is an interesting part as well. We've looked at before here on this channel. At the same time, global negative yielding debt has soared to $14.6 trillion from $11 trillion in January, and rapidly approaching the all-time high of $17 trillion hit 1 year ago. You see, the central bankers will tell you that this is like a phenomenon because of demographics, globalization, technology, but it's not. It's because they've been pushing this bubble. They've been buying bonds for decades now, starting with the Bank of Japan. They've been pushing speculators, investors into bonds, because they won't allow it their prices to drop or yields to rise, or else the whole house of cards would collapse. There would be not sufficient income out there to service these bonds, and that's the whole gist of it. Meanwhile, just 3% of the investable bond universe today yields more than 5%, a share that is close to an all-time low and represents a precipitous drop from levels seen roughly 2 decades ago. Consider that in the late 1990s, nearly 75% of bonds traded with yields above 5%, while sub 2% yields comprised under 10% of the market. That was before central banks took over capital markets and responded to a series of financial crises by slashing interest rates to ever lower and eventually negative rates, and launching trillions in bond buying programs that fundamentally altered the investing landscape. This has pushed investors into riskier segments in search of income, compelling them to lend lower quality companies and countries. They're quoting someone from Citi, Matt King, legendary credit strategist, they say. He says, Matt King, yield chasing behavior has become much more pronounced. If you are a pension fund or an insurance company, you are forced to go down in quality and take extreme risk. Why forced? Well, as I said earlier, they need the yield so they can pay policyholders. It all came to a head in this year's COVID crisis, when the Fed again cut interest rates to near zero and pledged to buy an unlimited quantity of government debt, and has been doing so, monetizing all gross Treasury issuance in 2020. The central bank also launched a number of emergency programs to shore up an unprecedented range of securities, including IG, junk bonds, and municipal debt, which sent investment grade prices to all-time highs and disconnected them from fundamentals. Investors expect additional stimulus measures to be announced at either this week's Fed meeting or the next one in September. So this article was written last week. And yields did drop after the Fed meeting. We saw the 10-year yield drop further down. After the latest round of interventions, real yields on U.S. Treasuries, which strip out expectations for inflation, have dropped to all-time lows of minus 1%. This move is the direct consequence of all the central bank support, said King. Well, even the Citibank or Citigroup guy is saying that. At the same time, though, if they hadn't been doing that, Mr. King, your bank would probably have gone under a long time ago. It is the main force driving investors to pile into risky assets such as gold and cryptos, both of which are at or near all-time highs. I would much rather own gold and silver and even cryptos than U.S. Treasuries, that's for sure. Those are the biggest bubbles, all the bonds, gold and silver, and cryptos to some extent. I think cryptos you need to be careful with. They're very volatile, but gold and silver are real money. They're not really going up. It's the currencies that are starting to collapse in value versus real money. So there you go. This is the biggest financial bubble, in my opinion, the bond bubble, not the stock market. So let's quickly look at where the markets are this morning. It's 8 a.m. London time. We've got spot gold at $1972.50, down about $3. Last night, when we opened the futures, gold got up to $19.95. So that's the high so far, overnight and today. The low's been $19.69. Silver is down 13 cents, just about 0.5% at $24.25. Silver got above 25 overnight as well. We got up to 25.03. The Dow futures down 73. S&P futures down 3 points. NASDAQ 100 futures up 0.33%. Sterling is down 0.2% at 130.65. The euro is down 0.25% at 117.50. So the dollar is getting a little bit of a rebound, a tiny rebound. The dollar is unchanged versus the yen at 105.95, and also unchanged versus the yuan at 698.33. WTI crude is down 0.75% at 40.04. The 10-year yield is up. Well, 10-year yield really is unchanged at 0.54. The 2-year yield is at 0.11, also unchanged. So bond market's fairly quiet. Later this week on Friday, we've got the U.S. jobs data. That will be the main economic release, I would say, for the week. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great start of the week. Take care. Bye.